Hello, everyone. Welcome back. It's a Tuesday, which means it is Tip Tuesday for us. And today's tip has us going straight over to our charts. Now, you guys that have been with us for any length of time know that charting is a huge part of what we do. We're talking about a three-leg trading table, which consists of fundamentals, technicals, and market tone. The particular topic for today is going to be part of that technical analysis. So we're actually going to be looking at what we call some secondary indicators. Obviously, you're going to need some type of charting software to have these available to you, but they're going to be pretty important. Now, technically, we include exponential moving averages and our secondary indicators. It's function F6 once you've downloaded David Mitchell settings, but I don't know. To me, exponential moving averages, they're very, very close to primary. So I really almost treat them that way as if they are primary, but we do list them as a secondary indicator. Then, of course, we have stochastics. That's for stocks that are generally moving in a similar direction over time. It is great with a buy point, late with a sell point. We'll take a look at what that is as well. But we also have several others listed once you download David Mitchell settings, and we don't often go into detail or even really discuss those. And so we're going to take a look at some of those today. So that'll be a little different. Even if you've been with us for a while, I would encourage you to stick around because you likely haven't seen a discussion over what we're talking about today. So hopefully you're planning on joining us. You're planning on sticking around here for the next 10 minutes or so. We're not going to give a full description on how to use these, but we are going to kind of talk a little bit about them and at least expose you to them so that you can see a little bit about what's happening there. So I'm going to go ahead and share my screen. And when I do so, I'm going to try to bring up the Telechart TC2000 version 7. That's what we're going to be looking at today. There are other versions. There are things that you could check out, but this is the one we like to use. We kind of encourage anybody that's a newer student to gravitate towards this version. Obviously, this is their version 20 here. You can just kind of see, even from just the look of the screen. Now, obviously, it's way busier as far as what I have up here. I have, an all weekly watch list. I've got the stock on a daily chart, got the stock on a minute chart, and then I've got the S&P, so I can kind of see everything that's going on. This is a snapshot of everything I want to see. So this is a pretty important. This is the basic screen I would watch on a regular basis throughout the day. So if I'm doing webinars or I'm talking to students, coaching them through opportunities, this is what I am going to be using. But for this particular session, we're actually going to go to version 7 here, and I'm going to hit function F12. So what we're going to do is kind of work through some of these keys. Function F12, as you can see, really clears up this chart. It's very straightforward. All we're seeing at this point, volume bars, the candlesticks, and maybe any lines that we've drawn. So it's a very fresh looking chart, a very simple looking chart. It's really a great way for you to probably just kind of start thinking through how to draw lines, because if all you're seeing is just the stock and just the candlesticks, now you're going to get a sense of what are my eyes drawn to. If I were to try to drop a line in here, could I make sense of what's happening? So we've got tractor supply, and obviously I have resistance, but let's just say we wanted to find support too. I'm on a right click, create a parallel line. And what you're going to see is we're going to get a pretty good support line here too. And I'm actually going to use the back bracket key to kind of go back in time. So if we had gone back in time and we had, had these lines sooner, then what we could see is that this stock stayed within the confines of that trading range for several months until it breaks out here in May. Does a kiss goodbye there, and then it really starts to change its pattern. But we had a really good idea of what that stock was doing during that stretch by drawing those lines. And what we want to do now is obviously go over here and get a sense for what is the stock doing now. So if I were to look at this stock now, I would go in here, I would still see, okay, well, here's a diagonal line here. And that's my range for now. We could adjust it a little bit, try to make it a little bit more exact, which we can do. It's not as easy on this particular version, but you can do it still. All right, now that's really where I wanted it to be. See if we can create a parallel. We can get a pretty decent, not great, but pretty decent idea of where support is on this. So again, we have an uptrend, we have Tractor Supply. What you guys will find is that Tractor Supply actually had a really strong move. I updated this morning, and I did not update before I came live. But this is probably actually near resistance today. So despite the market being down quite a bit, almost 30 points till right near the end where it kind of popped up about 5 points, Tractor Supply was fighting today. So if you were just to look at that chart, it gives you a general idea of what the candlesticks are doing, general direction, but not a ton of specificity except for support and resistance when you get a strong uptrending stock like this one has been a couple of times now over the last 6 or 7 months. So that's function F12, a space bar through again. So here's DT. And again, you just see very, very simple. But those of you guys that have been with us through step 1 or 2, here's an M pattern. Again, very easy to see. We want to make sure our eyes are seeing those very basic things. There's an M, and F12 allows us to do that. F6, function F6, that's going to be, again, one of the more common indicators that you're going to use for trading decisions. These exponential moving averages, they take an average of movement over time. I'm going to put that in a very simplistic way. But basically, the 10 days worth of data. The 20-day is 20 days worth of data, and the 50-day is 50 days worth of data. But they're really momentum indicators or gauges, if you will, of how hot that stock is. When the stock is on top of moving averages, then it's what we call a healthy stock. It uses these moving averages as trampolines. Let's go see if we can find one where it's been moving down, though. That one's not too much. May have to go. Okay, here's one that'll work for us for now. This is actually one we looked at last night, interesting enough, using these same indicators, looking at the moving averages, saying, look, if we get negative market tone today, this stock ought to drop from $61.48 down to $60. That was our expectation of that today, that based on these moving averages acting now, because they're on top of the stock, they act as weight. So they push the stock down. And we saw this one as a potential to drop down here to this $60 support area. And it gets close. I think it did drop a little bit more later. We actually caught it at the low when I updated this morning. But let's see if it did get even a little bit lower. I'm going to flip over here. I think it's SCTO. Not much. Oh, wow. We actually caught it when I updated it 1 penny away from the low. So it didn't quite get down to $60 here before it recovered. But pretty good idea. I mean, it did move down pretty well. Now, obviously, that's pretty cool that I updated 1 penny from the exact low. But you can kind of see that if you were to drop a line in here, I just hit my crosshairs there. That's your period key. When you hit your period key, it pops this line up, so it allows you to see things very quickly. So we can see this support area down there. I would have thought it would have fallen a little bit further and hit those, but now you have your EMAs on top. Again, they're acting as weights to push that down. That's F6. If you go to F7 or function F7, it depends on how your computer is set up. You may have to hit the little FN key to get this to switch from one thing to the next. Now you'll notice we're still looking at some of these moving averages, but with David's settings, we have a 20 exponential, a 50 exponential, and then we get the 100 and 200. So this brings in some of those longer moving averages, which don't really tend to come into play unless we've had really significant movement generally down because, the market likes to move up most of the time. So these 100 days, these 200 days would come into play after we had seen normally a substantial move down. But from time to time, these stocks do use those deeper or longer moving averages, and they can be helpful. You can see right here, this kind of stalled out there. It was at the white little dotted 200 range there. So sometimes they come into play. Here it kind of moved up off the 100 a little bit. So from time to time, those can be handy. They're not as reliable as the 10, 20, and 50. But again, when you get a healthy stock like MSCI, you'll notice that since it started to move up in March, the 100 and 200 haven't even been close because these EMAs, they're fanning out, right? So you got this bigger up move. So you got 20 days of really positive data. So that 20 days is going to be steep. Obviously, the 10-day will be the steepest here. 20 days flatter, 50 days flatter than the 100 and 200. You can see how they're definitely flattening out a little bit more there. All right, so that's F6, that's F7. We'll go to F8 real quick. Function F8 is, as you can see up here, it tells us that we're looking at Bollinger Bands. Now, obviously, we have some courses where if you're interested in learning more about this, you can contact support at Tradeway, and you can do that. But some of these things you can also look up online. Now, of course, you're going to get varying opinions on what some of these things, but for the most part, these are standardized secondary indicators. There are many more than what we have listed on available for our students on version 7. But there's some things online that you can go and look these up and see what they do. For the most part, the Bollinger Bands, they kind of act as a support and resistance range. And generally speaking, once the stock gets out of this range, it has a stronger tendency to move back down into it. So you can see that almost any time it gets out of it, it gets back into it, and then it has a tendency to stay into it. You can see over here, it did end up using these as support. It's not what I would say is extremely reliable as far as a current indicator, but you can tell, like, look, it really does like to stay within the confines of those yellow lines, and even when it gets out of it, it has a tendency to come back into it. Now you can see this stock's being a little weak. So we would anticipate that it's going to try to, get back in this range. But particularly when it's more narrow like that, you're going to get some pretty good indicators. Here's DHI. And again, just kind of hovering in that range. Sometimes we'll use this white line in the middle and move up or down off of it. You see how it used it as resistance right here and there. And then over here, it used it as support. Same thing here. So it is pretty cool. It's actually not a secondary indicator that we use a lot, but you can kind of tell just by looking at it, you know what, that's probably something that maybe it's not maybe the primary thing I would look at, or maybe even the second or third thing I would look at. But again, looking at Edwards Life Science here, Bollinger Bands have been pretty helpful with indicating moves up. For the most part, it has used that white line as support, and it stayed within the confines of the top side of that as resistance. So very, very interesting, right? So, and again, it's not always going to hold up, but really it's been pretty good, better on some than others, obviously. But, maybe something some of you guys just haven't paid a lot of attention to and might just want to check out from time to time. All right. So we've looked at F12, F7, F6, F7, F8. We'll go to F9 here. You'll notice that this is just, it says on balance. This is really not something I have ever really used. So it's not something that you're going to pay a lot of attention to. You can see as you go back over time, the trajectory of those yellow and white lines are going to change. Some of that is we're going to see when we move over to money stream here. You'll get a similar idea: money going in, money going out, and then they would cross. So you get a similar thing over here, but that's not one that I use hardly any at all. F10 changes things up drastically. We don't ever really use F10. In fact, you can see it's quite the mess. F11, pretty basic here again. It's not one that we use very often, but again, pretty much F11, F12, they're basically the same. So not much to see here. Now, let's go back to F5 then. And F5 is money stream, as I mentioned. And money stream is again, just kind of giving you an idea, is money going into or out of the stock. Well, I don't hardly ever use this one either. Why? Well, because it's reactionary. You might say, Geoffrey, aren't all of them reactionary? I mean, the moving averages, aren't they reactionary? They are, right? But not to the extent that this is. Like when we go to stochastics, you can tell that stochastics is great for a buy point. So it's an early indicator sometimes of potential future stock movement. I think the same thing goes into play with your moving average. So I do look at them differently than the money stream, which to me seems reactionary. And why would we look at that? Well, let's just say in May, it's pretty obvious coming off of this M. Okay, let's just kind of follow this through. Watch the yellow and white lines there. And you can see that as the stock starts to recover, the trajectory of these lines is going to change. But look, it's already been moving up. I mean, we've already gone from 42 to 52. And now here we are with the money stream going, hey, look, people are buying this. I'm like, are they? I didn't know. So to me, money stream is way too reactionary to be of much help to me. Now, I suppose if you're a very analytical person, you might come in there and be like, well, if you looked at it this way or whatever, it might be helpful. But to me, money stream, very reactionary. I rarely use it in my personal trading. F4. You can see here it's time segmented volume divergence. So we got a couple of things going on. We got RSI. RSI, if you guys are familiar with stochastics, works in similar ways. When it gets up here into the oversold category, then people sell. They did certainly there. Well, it says that they're supposed to be selling here. Did they? Not really. Well, okay, that bears out because it kind of ends up floating. So, but when you see a move like this, you wouldn't have to tell me the stock went down. If I saw this, I would be able to look at that and be like, that stock's getting ready to drop, and it did. Same thing over here. This stock's looked like it's ready to drop, and it was, but it's temporary. And again, to me, time segmented volume is definitely a secondary indicator, not something I would go to on a regular basis to look at my trading. But again, if you're kind of looking for some additional data, details, TSV could give you some insights. You've also got this kind of, I don't know, aqua line down here and red line. Those crossing over and moving do tell you a few things too. I'm not going to go into great detail here about what that's saying, but it's generally, it's going to give you an idea again of stocks movement. Function F3, very common one that we teach at step 1 and also allude to at step 2. See if I can find a stock that's going relatively flat for us that would maybe give us an indicator here of what's stochastics is doing. Yeah, I mean, this one, it's not so much. This one might be good. This one, because you see, we didn't need movement over time. It's best if the stock was actually rolling. Maybe it is a little bit back here, but it's actually too fast because it actually requires, with these settings, 1357, it actually is what we call a slower stochastic. So it requires more time to really kick in and work. But the way that this works is this line right here indicates that this ought to be a buy point. So when those lines cross, it ought to be a buy point. If you kind of carry this up, you would find that, yeah, indeed. So when these cross right over here, somewhere in that area, that was a pretty great buy point. This stock makes a really nice move up. In fact, it's over a $10 move. We look over here and see, well, this tells us we ought to be selling. It tends to be late, so that's a little bit late of a sign, but sure, it was right. This tells us we ought to be buying. Wow, fantastic. So again, it's pretty great for a buy point. It says that we ought to be selling right here. Again, that's late. So it's pretty great for buy points, really is. It's pretty phenomenal, really. It's just a mathematical formula, but somehow it can really help indicate the movement over time. And like you can see, it can be somewhat predictive here, which is pretty incredible. So if when you see, when you attend one of our live events, we're going to focus on F6, your 10, 20, 50 exponential moving averages, and then F3. And I think there's good reason for that. But there are some others that can be useful at times. Wilder's divergence, and not one I use very often, but you are looking again for the movement here of these lines. And you can see as the stock is moving, it's giving you some indications there of when patterns are changing. I do sense too that this one's a little late more often than not. But it does kind of at least start to help you with a pivot point back through there. See what that indicates, that it might be moving upwards, and then now it's like, oh wait, no, it's down, and then it stayed down, and those have stayed parallel. Again, not one that we use a lot, but it's available. And then relative strength, pretty straightforward. This line up here just tells you what the S&P is essentially doing and how this stock lines up to what the overall S&P is doing. A lot like going to the dual screen here and then lining these up. Let's see if we can zoom this out one more time. And you're going to see that for the most part, when you start to kind of look at the overall movement, the S&P looks fairly similar to this stock in movement. Now, this one's obviously a lot more flat, but the pattern is pretty similar. And so you can see kind of here, how is it performing relative to the S&P? Pretty much just like the S&P, right? So that's pretty interesting. Some here, Tractor Supply was underperforming. And then over here in the last couple of months, it's been outperforming. So that's kind of just an interesting thing. Again, here's DT just kind of hanging with the market. And again, I don't know that there's really much to see here as far as, it's going to impact my trading decisions. I wouldn't use relative strength for that, but it will give you an idea of if you are in more of I think a buy and hold mindset. Is my stock performing relative to the market, or is it weaker? Is it stronger? That kind of thing. So there we go. A little bit longer than normal. Went about, I guess 20, 25 minutes today, but there's a lot to cover. So, and that was just a brief overview. So if you're wanting to know some more about these secondary indicators, how you might be able to use them and what they do, of course, we have information available. So just contact support@tradeway.com if you're interested in learning more about these things. And that concludes our Tip Tuesday. So thanks again for being part of this. We appreciate you guys being on here and joining us each week. So whether you're doing it live or you're watching a review, appreciate you being with us. Look forward to seeing you again next week.